Most investor sentiment indicators ask a simple question: are investors optimistic or pessimistic? We believe that question is incomplete. What matters even more is whether today's optimism or pessimism is justified by what the market has actually done. Traditional sentiment indicators evaluate bullishness in absolute terms. Our research suggests sentiment should always be viewed in context. Strong markets naturally create optimism, while weak markets create pessimism. The real insight comes from measuring whether investor sentiment has moved further or less than market performance would historically suggest. Markets influence investor psychology. After strong returns, investors usually become more optimistic. After weaker returns, they become more cautious. That relationship has been observable for decades. Our framework measures when those two begin to separate. Those periods of divergence have historically provided useful information about future market conditions. When market performance is stronger than investor sentiment, history suggests many investors remain cautious. That can leave buying power available to support future advances. Conversely, when sentiment becomes more optimistic than recent market performance would justify, history suggests investors may already be heavily committed, leaving less incremental buying power available. This relationship forms the foundation of our divergence framework. To simplify interpretation, every historical observation is grouped into one of 5 quintiles. Future sentiment briefs will focus primarily on 3 of them. Q5 represents performance outrunning sentiment and has historically been constructive. Q3 reflects a balanced environment. Q1 represents sentiment outrunning performance and has historically called for greater caution. Across more than 60 years of market history, the strongest results occurred when performance outpaced sentiment rather than the other way around. The framework does not predict the future, but it provides historical probabilities that help place today's market environment into context. When the framework identified Q5 conditions within the 3-month trailing regime, subsequent returns and positive outcomes historically exceeded the long-term averages. Conversely, Q1 readings generally experienced weaker win rates and a greater probability of adverse outcomes. These observations form the historical foundation for future sentiment briefs. Every future edition of the Sentiment Brief will report the current quintile reading and summarize what history has shown under similar market conditions. Rather than reacting to headlines alone, this framework helps us evaluate whether investor psychology aligns with actual market performance. It provides additional context to support disciplined investment decisions. We enjoy providing helpful information to help you make sense of markets and important financial planning concepts. Engage LRG Wealth Advisors so we may apply market wisdom to your financial plan and investment portfolios so you may live the life you imagine. This is LaRue Gibson with LRG Wealth Advisors.